This conference will now be recorded.
Good afternoon, folks. It is the top of the hour. We'll give folks just a few more seconds to get dialed in here if they can. So we'll get rolling in about 45 seconds. Okay, let's get started. I want to respect everyone's time. Thank you all for attending this webinar on employer healthcare solutions. This is a topic that is top of mind for a lot of folks across a lot of different industries. It's relevant for recruiting, attraction, retention, your budgets, and what we're going to talk about today is really what we see currently, challenges and opportunities, and what we see coming down the pipe as well. I'm joined here today with Monique Parent, who's our Director of Benefits for TLC and Kimberly Group. Hello, Monique.
Hi, Eric.
Good to see you virtually there on the screen. My
Same
name is
here.
Eric Lynn, Chief Commercial Officer for TLC Companies and Kimberly Group Payroll Solutions. As mentioned, we're going to take you through quite a bit of topics in regards to benefits here today. I'm just going to go through a couple of housekeeping items for you. On your screen there, you see, if you don't want to see the top of the videos there, called Attendee 1, 2, and 3, myself, it's not a problem at all. Just click on that top box where it says everyone, and you can click hide everyone, and that'll eliminate that. You'll just see the presentation on the screen. Second piece of housekeeping, on the right top right hand corner of the screen, you'll see a chat box. Kendra already put a note in there. That is our repository for questions today. Unfortunately, we don't have an opportunity to go verbal with you via this platform, but we want to make sure we answer all questions you have today. And we will do that at the very end of the presentation. Thanks again for joining. We think it'll be great content for you today, and look forward to sharing that with you. So with that, I will kick it over to you, Monique. Take us away.
Thank you, Eric. Also, thanks for setting this up. This was a great idea. We wanted to do this informational webinar because employers are facing more challenges today than ever before, and providing health insurance for employees is no exception. I want to start here with a high-level view of some of those challenges, starting with a very brief review of the Affordable Care Act, or ACA. It's been around since 2010, so you're probably all familiar with it. The ACA penalties have been in place since 2015 for applicable large employers. You probably know who you are, but an applicable large employer is a company or control group of companies with 50 or more full-time equivalent employees. The penalties may apply if you don't offer employee health insurance meeting the ACA's coverage and affordability standards. I just wanted to make a side housekeeping note. If everybody could make sure they're on mute, that would be great. So also large employers have to demonstrate that at least the minimum coverage is being offered, and they can do this annually on forms 1094 and 1095C filed with the IRS. So one outcome of ACA was creating extra burdens for employers with 50 or more employees. Some good things came out of ACA too, such as accessibility for people with pre-existing conditions and a marketplace that simplifies purchasing individual coverage and small group health plans. The next on the slide here is a more immediate challenge confronting us all today. The COVID-19 pandemic has shaken businesses worldwide, from shutdowns to travel and commerce restrictions and even vaccination debates. Some businesses have actually benefited in this economy, but many have not. Here in the US, we continue to deal with the contradiction of soaring unemployment and staffing shortages, as well as government-imposed requirements as a result of the pandemic. And finally, employers have already been up against group health plan frustration for decades, from plan administration and compliance to annual group plan renewals that usually exceed 12% a year when annual inflation remains in the low single digits. While most of us do understand that health plan increases are driven by increasing healthcare claims and the escalating cost of healthcare itself, it doesn't make it any easier to accept or for a business to budget around. Expensive health insurance also leads to difficulties in recruiting as well as retaining quality workers. To add to employers' burdens, it can be overwhelming for many, especially small companies, to stay on top of increasing government compliance requirements, while at the same time trying to figure out whether trendy new healthcare opportunities are good, bad, or questionable. So in light of these employer challenges, the topic we're discussing today, as Eric mentioned, are types of health plans employers can offer and what to look for if you're about to go shopping for a group health plan. This discussion will center on these three areas on the screen here, starting with the most traditional option and still the most common, the employer-sponsored major medical plan. We'll also talk a little bit about MEC, or minimum coverage plans, and other limited benefit type plans. And finally, we'll review a couple of those trendy healthcare opportunities popping up right now. In the area of employer-sponsored major medical, we'll focus on two main ways to obtain it: direct market and multiple employer plans. In the direct market, the employer purchases insurance directly from an insurance carrier, either on their own or with the assistance of an agent or consultant. Whether the employer is eligible for small group or large group coverage depends on the number of employees. In most states, an employer with 2 to 49 employees is a small group, and 50 or more employees makes a large group. As a result of the ACA, small group plans are generally rated based on age and gender demographics and community rating, whereas large groups are often rated based on demographics and claims experience. ACA-inspired small group community rating can be beneficial to an employer in some parts of the country and more challenging in others. Another distinction for direct market is whether the plan is fully insured or self-insured. Fully insured means there's no risk to the employer for healthcare claims liability. The employer simply pays a monthly insurance premium, and the carrier pays claims according to the contract with no additional financial liability to the employer. Self-insured, on the other hand, means the employer takes on all or some liability for the cost of healthcare. There are different levels of self-insurance where the employer can buy coverage to mitigate their risk. This is called stop loss or reinsurance. But no matter what, in a self-insured plan, the employer has a vested interest in the claims experience of the plan to some degree. Regarding fully insured and self-insured, I was asked recently if there's a formula to figure out whether an employer should consider a self-insured plan. There really isn't, but in my experience, the more volume you have, the better, because you'll have more people and quote-unquote premium to spread the risk over. In my opinion, I wouldn't consider self-insuring a group of any less than 500 enrollees. However, in recent years, many carriers have developed self-insured plans that smaller employers can offer, even employers under 50. For these smaller groups, there's usually a structure called level funded, where the employer can still budget a simple monthly premium amount. The carrier usually then manages the self-insured elements, including reinsurance, administrative fees, and claims. Many groups do see significant savings with self-insurance, even as much as 10 to 20%. It's really a personal and business decision whether it would be right for your group. So let's move on to multiple employer plans, which includes PEO-sponsored master medical plans, association plans, and union plans. First, let's chat about PEO-sponsored master medical plans. To do that, I'll first give you the simple explanation of PEO. A PEO is a professional employer organization providing payroll, payroll tax, work comp, employee benefits, and other HR-oriented services to its client employers. A significant value of using PEO services is to outsource employment-related administrative burdens, allowing the business owner and key staff more time to focus on running their business. Some PEOs also sponsor a master medical plan, and this provides another level of administrative outsourcing. Not only can you reallocate even more of your staff's time to running the business, but it can add up to significant savings on HR and benefits overhead costs. Most PEO plans allow client employers to participate in the master plan if they meet certain underwriting requirements. Association and union plans are exactly what they sound like. An association health plan starts with an association. An association is a group of individuals or businesses with a common interest or industry. Most associations offer some tangible benefits such as products, services, information, and discounts, as well as many intangibles such as networking, a sense of community, a common purpose, and even the opportunity to volunteer. An association can also sponsor a group health insurance plan with varying participation and membership requirements, and then allow businesses and their members or employees to enroll. There's actually much debate about the future of association health plans, in part because they don't have to follow all the ACA rules. One of the big ones is they don't have to have pre-existing condition. They don't have to allow pre-existing conditions to be covered. They can have an exclusion. For now, however, association plans do remain an option for small employers. When deciding whether or not to join an association health plan, you'll have to weigh the pros and cons at both the company level and the employee level. A union plan, again, is exactly what it sounds like. A health plan designed for union workers, which complies with their union's collective bargaining arrangement. Unions and associations are both specialized areas that we will not be discussing today, but I do want to dive into the PEO-sponsored master medical plan a bit more on the next slide.
So Monique, before we move on to that next slide, a couple of questions here. First one actually just got from a client last week, and that's regards to the size, the larger small groups of employees. So their question was, I'm in a situation where I have several companies that fall underneath an umbrella organization, but we all run independently and each of us has less than 50 employees. So are we then a small group by each entity, or is this aggregated to force us into being classified as a large group?
Well, depending on the ownership of each of the companies, you're likely in a control group. Even if each company has less than 50 employees, if the combined total of all the commonly owned companies is 50 or more, you're an applicable large employer and you do have to comply with ACA. However, if common ownership is not 100% across the board with all the companies, or it's not exactly the same with all the companies, it can get very complicated to determine if there's an actual control group status. So in that case, I would recommend getting legal advice about your specific situation.
Got it. Second question I've got for you on this slide is you've mentioned the term affordable a few times. How do you define this term for the audience?
Actually, this is defined by the ACA. It's a formula that uses the employee's wages and the cost for health insurance that's passed on to the employee. So here it is in a nutshell. Single coverage in the employer's lowest cost plan should cost the employee no more than 9.5% of the employee's wage. The 9.5% I use generally because that's how it started. But the IRS does release the affordability percentage every year, and it usually goes up just a little bit or down just a little bit. So far, though, it has remained between 9.5% and 10%. For 2021, it's 9.83%. For 2022, it's actually going to go down to 9.61%. And I'll just take a minute to give you an example. So the example would be an employee earning $50,000 a year. 9.61%, next year's percentage, is about $4,800 or $400 a month. In this example, when you're determining your employer contributions and employee rates for 2022, you would not be able to set the employee rate at more than $400 a month for single coverage in the lowest cost plan offered. Lowest cost plan just refers to if you offer more than one plan option for the employees to choose from, it's whatever costs the least to the employee. So this becomes more challenging for lower wage employees or when you have a mix of wages in your workforce, even more so when you have a plan with age banded rates, which is very common for smaller groups. All of these situations make it difficult for many employers to set consistent, non-discriminatory employee rates.
Very helpful deeper dive. Thank you, Monique.
Sure. Okay, so to paint the picture of a PEO master plan, we'll use TLC's plan as an example. The biggest value for client employers is full plan administration. In the TLC plan example, clients are hands-off. Once they start on the master medical plan, the PEO handles all employee benefits matters, from employee communications, enrollments and changes, and payroll deductions, to vendor issues, including plan administration, premium payments, among other things. The PEO also handles compliance, such as COBRA administration, 5500 filings, HIPAA, and ACA 1094, 1095 preparation when applicable. The value is, again, in the reduction of administrative responsibilities and allowing the owner and staff to concentrate on running their business, while still offering employees top quality benefits, including major medical. Reducing or redirecting HR benefits staff can also lead to staffing and overhead savings. And we've estimated most employers dedicate one HR benefits staff per 100 full-time employees, dedicated mostly to benefits administration. And the staffing savings alone could be at least $25,000 a year per 50 full-time employees. Some PEO plans also include PEO-provided life insurance with medical enrollment and/or third-party healthcare advocates like DirectPath. DirectPath isn't the only one out there, but it's the one that is included in the TLC plan. A healthcare advocate in general is a separate service outside of the PEO or insurance company that can assist with claims appeals, claims issues, as well as provider cost and quality comparisons for members, all of which can ultimately lead to savings for both the employee and the plan. TLC's master plan with Aetna also includes free CVS Minute Clinic visits and teledoc services. Aetna's partnership with CVS makes free access to Minute Clinic services possible for their groups. There's no out-of-pocket cost and no visit limit for the member. Aetna also includes teledoc with their plans. With teledoc, members can consult with a licensed physician by phone or video and resolve many basic medical issues, get prescriptions, and not have to worry about the stress of the doctor's office or the waiting room. The teledoc copay varies depending on the plan. So, not to dive into this any further today, but we would love to talk with you one-on-one about how a PEO master plan's full administration might be right for your business. Watch for our contact information at the end of the presentation. Next, we'll talk about limited benefit plans. Plans can be limited in various ways. First, MEC plans. MEC stands for Minimum Essential Coverage. MEC plans have been gaining in popularity since the start of the ACA because minimum essential coverage is one of the 2 ACA coverage requirements for applicable large employers. Offering a MEC plan can actually help the large employer to avoid the first and potentially largest ACA penalty, sometimes referred to as Penalty A. A MEC plan is primarily preventive care and screenings. It does not cover regular office visits, no prescriptions, no hospital coverage. But some MEC plans do have a buy-up feature or features, including a minimum value coverage option, which provides some hospitalization benefits and satisfies the second ACA penalty, also known as Penalty B. A MEC plan with a minimum value option can be more cost-effective than a major medical plan for some large employers to meet their ACA obligations and avoid penalties. Usually, the participation and contribution requirements are easier for an employer to manage than most of the major carriers' requirements for traditional plans. MEC and minimum value plans are usually self-insured, often fully funded or level funded to operate more like a fully insured plan. MEC minimum value plans are not a replacement for major medical coverage, but the attraction is the avoidance of the employer ACA penalties and the easier to meet participation requirements. Mini-med, or limited benefit plans, have been around for a while and have been overshadowed a bit by the MEC minimum value plans for the most part because of the ACA compliance issue. But they can be similar, primarily covering preventive care and sometimes office visits, prescriptions, and hospital stays, but with significant limitations. The limitations can be number of visits, number of days, or dollar amounts as determined by the plan. These, again, are not major medical and are never ACA compliant plans. Hospital indemnity and other indemnity plans are often used to supplement other limited healthcare plans that have no hospitalization benefits. These indemnity plans cover specific services, usually hospital services in this case, and payment is in the form of reimbursements in scheduled dollar amounts. There's usually a list of covered services and benefit amounts. The insured can receive that full benefit even if other insurance has already paid for all or part of the service. That reimbursement structure is a significant difference between this type of plan and most other plans. With major medical and even mini-med plans, the carrier pays all or most of the balance after the insured pays an out-of-pocket amount up front, such as a copay. One final note on this slide, I just want to say it's important to note that none of these plans are major medical coverage, and employees can often be confused by this. If you decide to offer plans like these, you need to be sure that it's very clear in enrollment materials that it's not major medical coverage. So just to review a few of the new products in the market, I've got 3 here. First is ICHRA. ICHRA stands for Individual Coverage Health Reimbursement Arrangement. It was just introduced in 2020. It's an ACA-approved option where instead of making contributions toward group health plan premiums, the employer provides money the employees can use to purchase individual insurance. And they can choose the plan that's best for them rather than being limited to whatever the employer has chosen to be available. It can be more cost-effective than a group plan and takes the employer out of the plan administrator role. It also breaks the group plan cycle of annual renewals, which leads to coverage becoming more and more expensive for everyone in the group over time. ICHRA does not work for all groups all the time, but it can be worth exploring. Individual coverage can be less costly, and annual increases can be more contained than group plans. And some employees may even qualify for government subsidies, which is a savings for both the employee and the employer. Bottom line, ICHRA is still very new and very unique. It would take way more time than we have today to fully explain, but we'd be happy to discuss the pros and cons of ICHRA more in depth, one-on-one with anyone who's interested. Again, we'll have our contact information at the end of the presentation. If you ultimately decide ICHRA is a good fit for your group, it can result in more choice for employees and less cost and administration for employers. Limited day benefit plans. These are similar to other plans we've discussed, including MEC, mini-med, and limited benefit plans. They tend to have low or no deductibles and nearly 100% upfront coverage for office visits and other common services, as well as some prescription, lab, and hospital coverage. The catch is that there are limitations based on number of days that each benefit is received. Again, it's not a replacement for major medical, but it can be an ACA compliant plan if set up properly. It can be very attractive for employees wanting low cost first dollar coverage and willing to take a risk on the limitations in the long run. Make sure you trust the vendor you're considering using for this type of plan and get a legal opinion if you're unsure. There's also a trendy new wellness type plan that's out there that capitalizes on the FICA savings of pre-tax premium deductions. The basic format involves charging employees a pre-tax premium for a wellness plan through payroll, resulting in tax savings for both employee and employer. The employee then takes part in monthly wellness activities to qualify for a reimbursement benefit that can offset the employee's payroll deducted premium. The net effect for the employee is either no cost or a slight raise in take-home pay, plus access to certain wellness benefits. The employer and the plan administrator share the employer FICA savings. While these programs can be compelling, I would use extreme caution when setting up a plan like this. Please consult your legal advisor on the possible pitfalls and legal concerns. Also, these plans are not a replacement for major medical and are not ACA compliant. So considering what employees want in a health plan should go into the whole decision process, but what they want is usually pretty straightforward. They want affordable office visit copays, usually in the $20 to $50 range for primary care and $30 to $75 for specialist care are reasonable ranges to consider. They also want affordable prescription copays, affordable deductibles, and maybe one of the most important, they want a generous employer contribution. They want to be able to afford the coverage for themselves and their families. And it may go without saying, but employees want easy to understand and use benefits. It's great to find an affordable plan, but if it has poor customer service or difficulties filing claims or receiving benefits, it can become more of a morale problem than a benefit.
So Monique, that term generous is a bit ambiguous. So for those on the call that are going through this decision-making process right now, how should they think about that term generous? Is there a range or anything, any kind of guidelines they should go by for that?
Yeah, I actually kind of left it generic on purpose because it's kind of it depends question. It depends on your business needs, your budget, and even your competition for recruiting quality workers in your industry. Obviously, the more you can contribute to health premiums, the more attractive your opportunity will be to the talent pool. It's a huge benefit for employees to have the peace of mind of affordable, quality health insurance coverage. A good rule of thumb is to contribute at least 75% of single to generate good participation and a solid offering. Also consider the affordability question that we talked about earlier. But from a group health plan standpoint, carriers usually have a minimum contribution requirement, and that's usually at least 50% of single in the lowest cost plan offered.
That's helpful. Thanks, Monique.
Sure. Okay, so then if you are an employer about to go shopping for a group health plan for the first time or to replace a current plan, there are some key questions to consider besides what the employees want. This can help you to maintain focus on what you're really looking for in your plan. First, do you have a current plan? If yes, when does it renew? About 2 to 3 months prior would be a good time to start shopping. Is it fully insured or self-insured? Is it company sponsored or through a PEO? And ultimately, are you happy with your current plan or looking for something different? If you don't have a current plan, why? Are you a new business, just getting started? Has your group been declined? Or maybe you've received quotes, but the rates are too high. Or maybe you don't have enough participation to qualify for a traditional plan. What is important to you in a new plan? Are you looking for a certain plan design, provider network, customer service, reasonable participation and contribution requirements, or maybe price is your main concern? And what about benefits administration? Could you see the advantages of a full benefits administration, hands off once the group is set up? Would that be more or less important to you than price ultimately? And then recruiting and retention. How important are medical and other benefits for your employees' compensation package? Do you have industry standards you need to live up to or competitors driving you to make changes? So even though our focus today was healthcare, here's a brief list of some of the other benefits employees are looking for. Of course, there's a trend of employees expecting more flexible work schedules and the ability to work from home. But beyond that, here are some of the benefits employees are counting on. Very high on the list is a 401k with a match or other employer contribution. Dental and vision insurance can be as important as health insurance to some employees. And many are also looking for disability and other income replacement benefits that help them pay the bills if they get sick or hurt and can't work, other than when it's work comp, of course. These types of disability and other benefits can be employer paid or voluntary options for the employee. Many employees are also looking for those extra voluntary benefits like cancer and critical illness. Just providing easy access is enough here. And finally, it's more important than ever to give employees an easy way to navigate their benefits and ability to enroll when they're eligible, as well as make changes during annual open enrollment, which is coming up for many of us. Today's world is one of technology, so providing an online enrollment option has become almost a necessity. And this is something that TLC, Kimberly Group, and other PEOs with master health plans can provide, in addition to the advantage and savings of full benefits administration. So
All
now would be
right.
the time. Yeah, go ahead.
Yeah, Q&A time. That's what that question mark reads out of the Riddler is now on the screen. So thanks, Monique, for taking us through that presentation. Kendra, any questions queued up in the chat box?
No.
All right, so one question on the, and we don't have to go back a slide, Kendra, but you had 401k up there, and a question I get a lot, Monique, is what's the difference between a 401k and deferred compensation plan?
Okay, yeah, it's actually the same thing. Deferred compensation is when you take the employee's elected contribution from their paycheck without applying state or federal income taxes. The employee is agreeing to defer those taxes until they retire and start withdrawing from their retirement account. The notion behind this is that when you retire, your annual income and tax bracket presumably go down, so you pay less taxes at that time, and you've deferred those taxes, but you're paying less in taxes. Most 401k plans also now have a Roth contribution option where the employee elects after-tax contributions. It's still a 401k contribution, it's just not deferred taxes. But Roth contributions and their earnings are not taxed at retirement. That would be the difference.
Got it. Another question I got emailed to me during the presentation by a client is what's the difference between an HSA or FSA plan?
Oh, that's a good question. HSA stands for Health Savings Account, and FSA stands for Flexible Spending Arrangement or Flexible Spending Account. So there's a couple of big differences. An FSA is a use it or lose it plan. In other words, the IRS makes this rule, and you have to elect your amount for the year. And if you haven't used the amount that you elected, you lose it. And basically, you forfeit that amount. If you elect $1,000 during the year and you've only submitted $800 in expenses that are eligible to be reimbursed, then you lose $200. You've still saved in taxes, but you lose that amount you didn't spend. In an HSA, it's a bank account that's established in your name and you never lose it. It carries forward year to year. You can keep adding to it, letting it grow. And by the time you retire, if you've built up a nice sizable balance, you can actually withdraw on it like you can your 401k. You would pay taxes at that time, but no penalties. So those are the big differences. They're both pre-tax savings plans in order to set aside money to pay for eligible medical expenses. But the use it or lose it is probably the biggest difference.
Got it. I'll continue to be the proxy of our shy audience today. Another question that
Can I jump
I
in real
get.
quick?
What's that?
Can I jump in real quick?
Oh, of course.
Great. We do have a question in the chat, and it is, how are the health plans rated? Do you provide 4-tier rates, even if it comes from the census of a small company?
I'm sorry, I lost the end of the question, but I'll start to kind of navigate through what it sounded like the question was. It sounds like the question is maybe about the TLC plan. And I will say that there's demographic rating. There's also some underwriting with some basic information that we gather from the group. We have a third party firm that does that underwriting for us. And in the TLC plan, we do have 4-tier rates: employee, employee plus spouse, employee plus child or children, and family. And that's pretty common out there right now.
Did that get the entire question answered, Kendra? Or was there something? I think I heard something about 4 tiers.
Yeah, I'll repeat the question. How are the health plans rated? Do you provide 4-tier rates, even if it comes from the census of a small company?
Okay. Yes. I mean, again, I'm assuming that question is geared towards the TLC plan, and we do have 4-tier rates for all of our participating client employers, regardless of what type of plan they came from. Even if they came from, I think maybe the basis of that question is, they might be coming from an age-banded plan. And even if the group is coming from an age-banded plan, which is common for under 50 size, they would come into our plan, and once they're approved and underwritten, the rates are 4-tier rates and they're composite, so they're not age-banded. I think that gets to the gist of that question.
Any other questions in the chat box, Kendra?
No, not right now.
So Monique, one final question I'll ask as a proxy to the audience and other clients is specific around mental wellness or well-being. And I believe this is really accelerated post-COVID or during COVID, since I guess we're not post it yet. But are we seeing any more benefits, sort of these ancillary products you just mentioned below on a previous slide, when it comes to mental well-being and making sure as an employer I have the ability to make sure my employees are engaged, but most importantly have an outlet or access to some professionals in the advent they want to uh, get anything off their chest, speak to someone because they're having a rough time, or acclimating, going back to work, what have you. Are we seeing more of that specifically when it comes to a lot of the differentiation we talked about earlier on recruiting, attraction, and retention?
Yes, actually, I'm seeing a lot of plans popping up out there that are geared towards mental health, mental well-being, and even just having a place to talk to somebody, especially during the pandemic when people were feeling, I'll even speak for myself. That first couple months, I was feeling very blue, just about being stuck at home, not being able to see my coworkers and other people. But yeah, insurance companies and other companies out there are putting products out there that speak to this. The only one that comes to mind is called My Talkspace. And I can't off the top of my head remember any of the other names of them, but one thing to think about is if you already have an EAP or an employee assistance plan, that can be the springboard to other types of things beyond just someone to talk to, but a lot of times there's referral programs to counseling services, and even the counselors themselves at an EAP are trained to talk through a lot of situations. So EAP is a good place to start, but like you did mention, it's becoming more and more important in today's world. So yeah, there are a lot of programs out there that specifically address that. And I think they would be great things to look into. At TLC, we do have an EAP that we have available for all of our employees, regardless of whether the employer is participating in our master medical plan or any other benefits. That EAP is out there for their use. So.
Got it. Thank you, Monique.
Sure.
And with that, that brings us to the end of our Q&A. We do have our contact information here on the final slide. My email, Monique's email is on there, website, phone number to get in touch with us. If you have additional questions, we'd be happy to answer those. Thank you again for taking some of your valuable time to spend with us today on this very important topic. We hope it helped. And once again, if you have any other questions, please do reach out. Monique, great job. Thank you so much. Kendra, as well as you. Stay safe out there, and we hope to talk soon. Take care, all.